Hello and welcome to The Print. I'm TCA Sharad Raghavan, economy editor at The Print. And today I'm going to be in conversation with Neelkanth Mishra. He's the chief economist at Axis Bank, but he's also a part-time member at the Prime Minister's Economic Advisory Council and is sure to have a lot of insights on the economy that all of us are going to find very valuable. Thank you so much, Mr. Mishra, for joining us.
Thank you, Sharad, for having me.
So, Mr. Mishra, I'm going to start with the latest GDP data that just came out. It showed that in Q1 we grew at 6.7%, which is slightly lower. It's the RBI had predicted 7.1%. So now is this, do you feel a satisfactory start to the financial year, or do we need to do something more to reach the 7.1% target that everybody seems to agree for the year?
No, I think more needs to be done. So that's the short answer. Let's give it a longer perspective. Starting Jan 23, we were seeing a spate of upgrades to our growth forecasts. So FY24, so if you were sitting in Jan 23, FY24 was the next fiscal year. FY24, a number of senior economists thought would see, say, 5.5% or somewhere even at 4.8% growth. It turned out to be 8% plus. On that higher base, FY25 growth was also upgraded from the 5.5-6% range to 7.1% range, as you're talking about. So in level terms, the expectation for the level of output in FY25 has been upgraded by 3.5%, if not more. Okay. Now, what we are seeing now is that the pace of upgrades, or the upgrades announced, have stopped happening, in the sense that some multinational agencies have been upgrading GDP growth numbers, but the positive surprises in India's growth momentum have stopped occurring. So that's the longer background. So basically, this expectation some had that 8% could become our trend growth. So in Outlook note last year, we wrote that the trend growth will start becoming 7%. And that's very important, because then you can achieve 7% growth without driving inflation up and creating other problems. So can trend growth become 8%? Looks unlikely. So that's the first big picture. The second is that cyclically, there has been a very strong headwind for the economy, and it has come from two sources. The first is fiscal tightening, which has become too much and too fast, and it's not intended, meaning that in the first 4 months of this year, the union government's fiscal deficit is only 17% of its full year target.
Right.
Now, at the same time last year, it was 45%. So there is a 28% lower fiscal deficit in the first 4 months.
And that's the inflation effect, I'm guessing. That's the election effect, I'm guessing.
Election effect, correct. So because government spending, and so CAPEX is down 18% year on year. It is budgeted to be up 11%, but it's actually in real terms, in actuality, first 4 months is down 18%. So when you see this quantum of fiscal contraction squeezed into just 4 months, there is bound to be some slowdown in the economy. So it is not just the first quarter, which you're right, showed a slowdown. It was lower than RBI's target. I still think that the numbers may actually need to be revised down, because I think the growth momentum in the first quarter, in terms of cement volumes, in terms of auto volumes, in terms of the results of published companies, was actually much weaker than what the CSO's data said. CSO has access to more data than we do, but still the momentum looked a bit weaker, and I won't be surprised if the first quarter numbers get revised down. But the worrying thing is that even in July and August, the growth momentum hasn't really picked up. Now, I think the reason for that is the fiscal contraction that I talked about. And on top of that, there is also the tightening of monetary conditions. So while the interest rates are where they are, the money supply in the economy, as you know, for the economy to grow, you need a certain quantity of money to fuel the transactions or to facilitate the transactions. And the money supply in the economy has actually also started to slow. And so this fiscal and monetary tightening happening at the same time is something that has slowed the economy. I think this is temporary. What should happen, because as the government sort of establishes, the new regime is in place, the bureaucrats are in place, now the files are moving, the expenditure should start to pick up, and that should be a stimulus to the economy. Similarly, we have observed that the Reserve Bank of India is now comfortable with overnight liquidity surpluses, and which means that they are signaling to the markets that they are likely to support the creation of deposits. And the market is not trusting them yet because they were very tight stance for nearly a year and a half.
Right.
But as they maintain this liquidity surplus overnight, our expectation is that the markets will start believing that this will stay for a while, and that starts to ease the monetary conditions, and that should also support growth in the second half of this year.
Okay, so now we are seeing some sort of small green shoots in private investment, particularly in the infrastructure segments. And also there's some talk of rural demand also reviving, especially because the monsoon this time has been better than last year. But given that the private sector investment still is at very small green shoots levels and that rural demand is still contingent on the monsoon, do you feel that the government might have been a little too quick in curbing its the growth in the capex, where it kept it at the same level as the interim budget, but hasn't really matched the growth that we saw in capex in the previous years? That maybe one more year of growth might have helped the economy.
Those kind of debates, I think, one needs to keep having, because it's not that there is, when you are doing forward-looking analysis or you're trying to do projections or you're setting policy, I mean, there needs to be a healthy debate on whether this was the right call, whether it should have been pushed out for one more year as well. But there is another challenge at the central government level, which is that the avenues on which the central government can actually quite limited. So as per the Constitution of India, on the infrastructure side, the central government can spend on national highways, can spend on railways, major ports, airports, and a couple of other things, telecom like in BSNL, etc.
Right.
Now, in national highways, we are already building 16,000 kilometers of national highways every year. And frankly, with a 160,000 kilometer national network, if you think that one set of one road has to be relayed once every 10 years, 16,000 kilometers a year is pretty much the max you can do and you need to do, right? So there are still expressways to be commissioned, and a lot of them are underway. So I think a significant expansion is perhaps not necessary. The railways can potentially take on more capex, meaning it can absorb, it has the absorptive capacity because there's so much more capacity needs to be built. But they've also done a reasonably good job of moving from a 1.5 lakh crore capex to now 3.5 lakh crores of capex, and potentially in the next 5 years reaching 4.5 lakh crores of capex. But there are absorptive or other limits to absorptive capacity in the railways as to how much capex you can do. Right. Major ports and airports are actually not that large in terms of their ability to absorb money. So therefore, even in this 11.1 lakh crore of capex that is budgeted, you would have seen there is 75,000 crores is actually that R&D budget or rather the R&D pool that the government has created for pre-commercial R&D.
Right.
There is still higher capex being allocated for state governments to do capex, because the avenues, or at least the subjects on which state governments can do capex, is much larger. So the center is realizing that the economy needs more capex, but there are only a few things that it can directly invest on productively. So I think that is also a limitation that we need to keep in mind when we are evaluating how much more capex it can do.
And that's why it's increasing the quantum of those 50-year interest-free loans for
Exactly. Because the states need to build highways, the states need to invest in urban infrastructure, the states need to build more metro rail, the states need to spend more on irrigation, on power distribution. So there's a lot of stuff that states have the mandate to spend on and should be spending on. And so that will be more productively useful or more productive and useful. Now, on the point you made about the economy seeing green shoots in private sector capex, so remember that the slowdown that happened from 2012 to 2019 or 2021, through COVID, was primarily driven by two factors. The first was the downturn in the real estate market in urban areas, and the second was the downturn in power generation, because we had built excessive capacity till 2016-17 when those capacities were commissioned. And so from 17 to 24, therefore, there was, other than some increase in solar power generation, there was barely any increase in capacity. On both fronts, there is reason to be optimistic that the real estate launches are now starting to go up, inventory levels are very low, construction needs to start picking up. And on the power side as well, we are starting to hit limits at peak power. And therefore, you are seeing that utility companies are starting to expand their expansion plans, and they're talking about commissioning more capacity in the next 5-7 years. With real estate going up, the inputs to real estate, so we are starting to see cement companies becoming more aggressive with expansion. Some of it is competitive as well, but some of it is a response to the expectation that there would be more construction of houses. Steel companies, most of the major ones, are talking about doubling their capacity by 2030 or 32. So there is a significant amount of capex that is starting to come up. I wouldn't call it in very early stages, because remember that GFCF to GDP, the gross fixed capital formation as a percentage of GDP, had fallen from 34% in FY12 to 27% in FY21.
Yes.
And it is now already up to 31% or so. So there has been a reasonable rebound. Our recovery post-COVID has been driven by investments. Some of it is, of course, the government itself, but I think non-government, basically private, corporate, and household capex has actually started to pick up. And we expect that in the next 5 years, this number will keep going.
Okay, but now coming to the larger private sector and say the manufacturing push, and especially the export-oriented manufacturing push. Recently, the World Bank came out with its India Development Update, and they had a particular section on trade. And the point that they highlighted was that while India has been increasing, the gross value added in terms of the high-tech exports, when it comes to the employment generation sectors, things like apparels, textiles, footwear, our share and our exports has actually been falling. And that share has been taken up by Bangladesh, Vietnam. And it said that this is a concern because we need to be increasing our employment. So, I mean, do you feel that there is some sort of relook that needs to happen in this area?
So let's first divide this problem into two parts. And so on the second part, where the fact that we need to have done a better job than we did as a country on grabbing the business that was exiting China because they are short of workers, so their workforce is shrinking. And India has not so far been very successful in capturing that business. A lot of that business, as you're rightly saying, has gone to Vietnam, Cambodia, Bangladesh, and all that. And we should be doing more to get that. And I think within the government also, there is a realization that perhaps the industry itself, the apparel industry itself, is not giving or asking for the right kind of inputs and interventions which can help them win this business. But at the same time, when we think about trade openness or exports, remember that as we go from, say, give or take a $4 trillion economy right now to, say, a $20 trillion economy, say, depending on who you ask, 15, 20 years later, only about $1 trillion of that additional 16 trillion, in my view, is likely to be dependent on external demand. The remaining 15 trillion will have to come from domestic demand. Just to give you perspective, even today, right, June 2024, China's goods trade surplus was $99 billion. if you annualize it, you do seasonal adjustment, annualize it, it's not more than 1.1, $1.2 trillion. So China is a $20 trillion economy. A known successful case study on manufacturing. And yet, not more than $1 trillion of that 20 trillion is actually its a good straight surplus. So as we think about our own growth, so trade openness is very important for our manufacturers to be efficient, productive, and have high value added. But it would be wrong to expect all of this growth to just come from exports.
Okay.
In fact, the domestic demand and therefore the cyclicality of local housing, the investments in urban infrastructure, the investment in a lot of social infrastructure like health and education, I think those are going to be also job creating and value adding.
Okay, yeah. So then I was actually going to come to that. If then the driver of the economy is going to be the domestic market, then we're going to have to boost demand across the board, from the bottom of the economy to the top, and from urban to rural. So how does one go about this when large parts of our labor force is kind of unskilled, low levels of education, they're largely unemployable, and there's not much demand. A lot of them have very low incomes, so they can't really spend on things that our companies would like to sell. How does one square this circle?
So, growth and engineering growth for a sixth of humanity is never going to be easy, and one shouldn't expect it to be easy. You have this in economics, this vicious, these vicious cycles where it was like banking, right? So there was a certain cost to banking because if you had a bank branch and one person, one client, one customer visited the bank branch once a month, the costs were so high because per branch visit, if you amortize the cost of real estate, the air conditioning, the staff sitting there, the lighting and the paperwork and all that, the customer 9,000-10,000 rupees on average in their savings account for the bank, that customer to be viable. Now, because the banks could not afford to keep customers with lower bank balances than that, they didn't go to many of the areas. And because the banks didn't go to many of these areas, those people could not get access to bank accounts and therefore were not as productive. So it's a very vicious cycle.
Right.
The way we broke through that was by using technology to bring down the unit cost of banking. So if the moment we transition from bank branches to mobile banking, the cost of someone having a bank account is very low for the bank, and therefore everyone starts to get a bank account. The moment they start getting bank accounts, then a lot of other productivity drivers start to come through. I think what we need to do is to break through some of these vicious cycles, bring down the unit cost. So for example, if there is a certain market for a CT scan, say at 2,000 rupees or 5,000 rupees, it is very difficult for CT scans to be made available in small Mufassil towns because there will be very very few people who can access that. Now, if we can bring down the cost for technology, it may not happen very quickly, but say over a period of 5-7 years, bring down that cost to 200 or 500 rupees. Use, instead of trained human pathologists, you use some AI engines and then some supervision. You use remote diagnostics. You do whatever. Find new types of technologies for CT scanner machines. Right. The services can be made available to a much larger set of people. Then volumes start to expand very dramatically, and that kind of pays for the whole thing. So those are the kinds of innovations that I think we need to do. What I think is in our favor is that we have successfully built digital public infrastructure. Our ecosystems are primed for the government to just give directions. Remember that in most of the things, the government just gives the outlines, and every single part of that business, part of that ecosystem is staffed by private companies. and there are market forces which keep everyone honest and efficient, but the guidelines and the structures are provided by the government. So the more sectors we are able to do this in, the faster we can grow. See, as of now, for the next 3 to 5 years, I expect that the upturn in the real estate cycle, because inventories are low, demand is growing, and the construction of these houses creates a lot of demand. Demand for labor, demand for steel, glass, cement, wood, everything. And that itself then creates more jobs and more income. So for the next several years, I think we should be okay to grow at 7% in real terms. However, if you need to grow at 8 to 9%, we need to start thinking of more creative policy tools and measures. For example, thinking about how do we create more urban infrastructure in 1,000 cities. See, the Mumbai real estate market would not be as strong as it is if the promise of the coastal road, promise of the metro rail was not there. The northern suburbs of, say, Goregaon would not be seeing houses selling at similar prices as, say, central Mumbai. So the thing is, after 2-3 decades, we're finally starting to see some infrastructure in Mumbai. Can we do the same in 1,000 cities? And can we decentralize? Can we give them more fiscal resources? Now, as that starts to happen, I think so as you say, 1,000 cities, even if give 1,000 cities a lot of fiscal resources, it is quite possible that maybe half of them or 2/3 of them will misuse it or waste it. But even if 1/3 of them start to work, the villages around those cities will start to see much better traction. So I think there are ways and ways of solving for these vexed economic problems. But that's the direction of travel. I think we need to decentralize more than we have done so far. And I think build new layers on our digital public infrastructure.
Right. So that actually is a very interesting point that you talk about decentralizing, because so far in the last 10 years or so, there's been a lot of talk about how things have been increasingly centralized. You have had a strong government at the center, it's a single party majority, decision making has been much more, well, decisive. And so there's been a lot of talk of centralization, but you're saying that maybe some of this needs to reverse, decision making needs to go back, and resources need to go back to the state level so that things can get moving on the ground?
I'm not sure I agree with that assessment of what has happened over the last 10 years. So what you will see is that the finance commissions, which actually define or decide on the allocation of the vertical devolution and the horizontal devolution. So say if 100 rupees of taxes are being collected by the center, how much of that goes to the states and how much goes to which state, right? So the first is vertical and the horizontal devolution. And then they've also, over the last 2 finance commissions, started to allocate directly to the tier 3 governments. So the Nagarpalika, basically the municipal corporations and the Gram Panchayats. And so those allocations have actually gone up. And what you will see is with the center itself saying that, look, I am done with, there's so much, only so much that we can do on CapEx, but, you need to do a lot more CapEx and we have the resources. So here are interest-free loans, take it from us, meet these criteria, you can do what you want. So I think that spirit of decentralization is very much there. In fact, what we've heard even the Prime Minister say is that every district needs to start thinking about its own growth. This whole concept of one district, one product. These are all concepts which are meant to encourage this type of thinking. And frankly, as we see newer and newer states meaning more and more states, like every large state now in India seems to have $1 trillion GDP target. If you see the competition among the states for attracting FDI, so if in some of the projects you will see that the first announcement says I'll be in state A, 3 months later you will see that same proposal is now located in state B, and you say what happened? Oh, they gave us more attractive conditions. So We are starting to see this move, but so far it has just gone from center to state. The importance of state governments, because they control the factors of production, they control land, they control labor as per the constitution, they control last mile energy prices, they control environment regulations. So there's so much more that state governments do. And I think it is time now to go one level below that as well. So that, I think, for example, state finance commissions have not been working. In most states, they don't even get constituted. Just like there is a Central Union Finance Commission, which decides on if the center is getting 100 rupees, what goes to whom. The states are supposed to have state finance commissions, which then decide on the devolution within the state. Most states don't even constitute them. So I think that is the challenge. That is the policy challenge of getting some progressive chief ministers to let go and allow the districts to take care of themselves.
Okay, and now as a sort of summing up of this conversation, I know that you can't divulge too many details, but what are some of the issues that are occupying the minds in the PMEAC? What are the vexing issues that all of you are trying to tackle? I know you hinted at one of them, which is that you're trying to figure out how we can get more share back from Bangladesh, Vietnam, in terms of our high employment export sectors. But what are some of the others?
So you're right. I can't and I shouldn't be speaking on behalf of the EACPM. I don't think it will be appropriate. And frankly, I mean, there are some of the views that we have are actually quite reasonably public. But if you ask for what is perhaps the biggest challenge for the country as a whole, I think it is the fact that any country that goes through this phase of growth, where over a generation, the percentage of people working in agriculture is likely to drop from, say, about 40% to 20%, sees the pricing power of labor being less than the pricing power of capital. See, when you go through this phase, your capital is in shortage, labor is in surplus, right? Because there are so many people. And it doesn't happen because some farmer goes from her position as a farmer and her children then take on a non-farming kind of role. So it happens over a generation, about 20 years. And during this period, there is a surplus of labor and there is a shortage of capital. So for example, when people say that Indian companies don't do R&D, India is at a stage where capital is in such shortage that very commoditized types of production, like say PVC pipes, you buy pellets, melt them, cast them, brand them, and you get 20-25% return on capital employed. Why would you want to take risky R&D? So at this stage of development, capital is in short supply and labor is in abundant supply.
Right.
When this happens, inequality starts to go up. And this is something which is very visible. So there is some of the increase in inequality that we have seen in the last 3-4 years is because of the pandemic, because we are about 1.5 years behind where we were supposed to be, where it would have been if pandemic had not happened. But and so that means there is about 1.5 crore extra workers, and because of that, labor has even less pricing power than it would. So some of it is cyclical, and hopefully we can catch up on that. But there is also a longer-term problem. And what is unique about India is that we are the only country in the world, perhaps, which is going through this phase while having universal franchise, which is a good thing. I mean, I think we should all be very proud that some people call it a precautious democracy, that we become a democratic even before we become rich. Most countries have, when they went through this phase, were not democracies, or at least didn't have universal franchise. So like Japan didn't have it till 1924. The UK didn't have it till the First World War. China very famously still doesn't have it. China and Taiwan were autocracies when they were going through this phase. So handling this or growing through this phase without growing inequality too much is, I think, a policy challenge which should be on the minds of every single thinker, every single policymaker.
And democracy does make things a little tougher in this regard. I mean, obviously, if you were an autocracy and you could just bull your way through, then that would be easier.
Yeah, but then then you start to question who is the growth for, right? I mean, see the whole the promise we made to our citizens and our fellow country people that that it has to be equitable growth, it has to reach everyone.
Absolutely.
So the fact that there is a structural strategic aspect to it, that there is a shortage of capital and too many workers, is definitely a challenge. Now, how do you address that? Do you address that by increasing capital formation, by allowing more and more foreign companies to come to India? You use digital public infrastructure to allow for more distributed sort of allocation of capital. So loans being made available in smaller denominations, equity capital, risk capital being made available in smaller denominations, so that there's more entrepreneurship. How do you use digital public infrastructure like ONDC to make markets more open, so that there are no gatekeepers? A small taat sari maker in Purulia district in West Bengal can sell, say to some aficionado in Mumbai, and all she needs to do is be on the website, and the logistics, the financing, the distribution, the ordering, everything is taken care of by the network. I think these are the kind of solutions that I think we need to work with to make sure that the rise in inequality does not happen, and we can continue down this path.
Fantastic. But on that note, that's all we have time for. Thank you so much for joining us. This was a wonderful discussion.
Thank you, Sharad. Thank you for having me.